So what a blood test does is it allows us, so we're talking about financial ratios, what a blood test does is it allows us to look at our general health. But the doctor doesn't necessarily just focus on a specific number. Sometimes the numbers are, sometimes the numbers have to be related to our situation. So for instance, sometimes people might have, say, an anemia. And the fact is, the anemia is part of a trait, maybe in the place where their ancestors come from. So as long as you keep it in check or take an iron pill, it doesn't necessarily raise an alarm for the doctor. They just want to keep an eye on it. If somebody walks in and they didn't know that, and they see a low blood, red blood cell, well, then they might say, wow, there might be an issue here. But again, you have to look at it in context to the ratio. So the different ratios are liquidity ratios, asset turnover ratios, financial leverage ratios, profitability ratios, and dividend policy ratios. So to go through it briefly, a liquidity ratio is broken down into a number of things. So the first is the current ratio. So what we're looking for here is that a company has enough short-term cash. And if it has enough short-term cash, it could meet its short-term cash needs. So effectively, the current ratio measures your assets less over your liabilities. And think about it again personally. You know that every week every week you're going to need cash to buy groceries, to pay bills, to pay your monthly bills, your utilities, your cable, what have you, mortgage, rent. So you want to always have more cash on hand than your short-term liabilities. And it's the same thing for a business. Business needs to think about it the same way. So one of the things that you have to focus on in the current ratio is that you have more current assets over liabilities. So short-term creditors or people who lend you money are going to want to see strong current ratios, and that's why we're going to look at our assets on our balance sheet over our liabilities. And if I had to give you a number, and every number, everything in a financial ratio is always relative to other companies in your industry. You always want to kind of think of it that way, because some industries require more cash, some might require less. Depends on the capital intensity and the things like that. Like, for instance, an airline isn't paying bills every month like, say, for instance, a supermarket. But that again is part of your analysis in the professional world. So the current ratio here would be the current assets over current liabilities. That would be a number usually around 1.5 to 2 is a nice thing to have, and even personally, to have 1.5 to 2 times the current assets over liabilities would be a good thing. Then you got the quick ratio, which is your current assets less your inventory. And why do we take out inventory? Because while inventory might be a short-term asset, it depends on the inventory. Now, if your inventory is automobiles, brand new automobiles on the lot, or gold or oil, you could turn that into cash. But if it's something like a perishable product, like a food stuff, like produce, or it's something like clothing that could either get old or lose its fabric, even just not be as functional as a piece of clothing, well, then you may want to take a discount on that inventory. So a lot of times what we'll do is we'll take that out and we'll call that the quick ratio. But again, a call you need to make. Again, like a doctor, you have to kind of use your, and the more of this you do, the better of it you get, the better you're going to get. Cash ratio is kind of the flip side. We want to add marketable securities. We want to add the marketable securities. So if I have short-term treasuries on the books, if I have stocks that are liquid like IBM or Apple, well then I might want to add that to my cash. And again, you may want to do that personally. If you have stocks in a stock account and you, for whatever reason, come into a month or two where you have a cash shortfall, maybe you spent extra money that month, maybe you went on vacation, maybe you want to use some of your investment money to go on that vacation, well, you could sell IBM in a second nowadays with your phone or online. So these are the 3 ratios we're going to focus on in terms of liquidity. Now, asset turnover ratios are a little different. How effective are my assets? How am I utilizing my assets? Well, first thing is we're going to have is a receivables turnover. So every year or every month or however you calibrate your accounting, you're going to have these credit sales. That's going to be sales that you made to your clients on credit. And some businesses, again, have a lot of clients that they've been doing business forever, but they're on a credit basis. Supermarkets I can think of, they don't pay for all the stuff when it comes in. They're on a credit basis. So you take your annual credit sales over your accounts receivable, and you can see how much think about this. Your accounts receivable tells you how much people owe you, and your annual credit sales tells you how much you gave to everybody over the year. So if you divide one over the other, you're going to get an idea as to how many times you're turning over that credit. So if I have $1 million in annual credit sales, and I have $200,000 at any given time in accounts receivable, effectively I'm turning over my assets 5 times. I'm turning over my receivables 5 times, which is good because it tells me not only am I making those sales, but how often I'm getting that money back, which is important, and creditors want to see that. Now, another way you can flip this around by just doing some simple algebra is taking the accounts receivable, now flipping it on top. You do the algebra, and then put the credit sales on the bottom and divide that by 365. Now, if you do the math that way, you're going to see how many days it takes you to collect. So, for instance, let's use my example. We have 200,000 over $1 million. We divide the $1 million by 365. You're going to get the average period that you're going to need to collect that money. So, if I did the math, and I have to kind of pull up a calculator here, we have 200,000 in receivables. Right? We have 200,000 in receivables. And we have $1 million, 365, which comes out to about $2,739. If I take the receivables, that means every 73 days I'm turning over my my receivables. So I just want to double check that number. I have 200,000, and I got $1 million. And if I take $1 million, you can do this yourself. Take a minute, pause this, take a minute and do it so you know how this works for your own business. And I divide that by 365, which gives me 2,739. If I take 20,000 divided by 200,000 divided by 2,739. I'm roughly going to get every 73 days I turn over my receivables. If I take the 365, or if I take the 365 and divide it by 0.73, okay, then I'm going to get my average collection period. Okay, so that's just 3 ways to look at the same thing. That's just 3 ways to look at the same thing and get the same number. And you also want to see it on a sometimes for people, it's much better for managers, it's much better to see it on a day basis. It's much better to see it on a day basis. But again, if you're lending money out to your clients, you really want to keep an eye on this, because if that number starts to drop, if that number starts to get bigger, if it takes you more time to collect your receivables, well, that could be a problem, right? If I take 365 and divide it by that 5, that first number, I'm getting the same 73 days. Now, if you see that number's growing, you might have an issue. You might say, you know what, why aren't my clients paying me? That could be a function of the general economy. That doesn't necessarily have to be a client-specific problem, but you definitely want to keep an eye on it. And if one customer is a big customer and they're having issues, you may want to sit with them. The one thing you don't want to do, or at least you want to consider, is you don't want a new manager coming in and saying, let's collect this money quicker. Let's get this money in the door quicker. And going back to your clients now and putting the squeeze on them and saying, listen, pay me a little quicker, we're going to change the terms. You could lose customers that way, especially if they're good customers. On the other hand, and that's why these are just indicators, if you see that it's taking more time, you may want to sit with them and see, are you having an issue? It could be just general economy. It could be nothing, but you want to definitely stay on top of it. Inventory turnover is a little different. Inventory is dead money, and that's it. I'm not going to lie to you. If you're carrying inventory, you're carrying dead money, because that's doing nothing for you. The key is to kind of sell that inventory, to get that inventory moving. Now, you don't want to, but you have to carry inventory. Think about it when you go buy a car. You go to one lot and they have very little cars. The lot is sparse. You kind of look at it, you hope you have an idea. You go in another lot and there's a lot of cars, a lot of choices, a lot of colors, a lot of amenities, and you wind up buying the car. So it is a fine line, and that's like management 101 or marketing 101 or just being a good boss, being a good, business person. How much do I need in terms of inventory to cover to make sure I get the maximum amount of sales, not carry all that dead wood? So cost of goods sold is how much I'm selling every year, right? That's the cost of what I'm selling every year in terms of goods. Divide by my inventory, and that's how often I'm turning over my inventory. So if again, let's use the same example. If I have $1 million in cost of goods sold, and I have 200,000 in average inventory, I'm turning over my inventory 5 times a year. Now I knew a guy once that we did consulting for. He told me it was like a fulfillment business. It was like a business where he was providing plastic wrap and paper towels and all that stuff for restaurants. And he was proud of the fact that he turned over inventory 52 times a year. 52 times a year. And at first I kind of thought, does this guy really do this? I mean, who turns over inventory that much? But he showed me the books, and as I sat there, I said, yeah, in fact, he was very proud of that. I don't know that he should have been so proud of it. Because sometimes what happens if a new client comes? What happens if it's during a heavy weekend and people need more stuff? What it's telling me is you don't have enough inventory on hand. And so your client is going to know that too, and they may say, well, I'll call somebody else when I need bigger orders. I mean, you don't want to be that, you don't want to be that tight on your inventory, because there are times, think about Peloton. Peloton, when COVID hit, Peloton, all of a sudden, their sales exploded. Problem was they couldn't meet the sales demand. Now, am I going to say Peloton should have anticipated COVID? No, but good managers know how to give themselves some leeway in their supply chain and make sure the inventory is there when the business picks up. Look at this thing with Stanley, these cups, these crazy cups that everybody's using. Now Stanley has this great chance to sell all of these cups, and they prepared for it. They marketed it that way. If you read the story of Stanley and these big cups with the straw, you see real good management there, because this was a company that really just dealt with the construction trade, and now they were able to sell to everybody. But they were ready for it. So again, just like these other ones, I'm not going to belabor the point. You can work out the math, but then you can also see what this looks like by doing the algebra or doing the math, how many days it takes you to turn over inventory. But the key you want to remember on both of them is you want to make sure that there's a balance, and a balance that looks like what the industry does in terms of using enough inventory to make all the maximum amount of sales. Carry too much, a little dead wood. Carry too little, you can miss out on opportunities. And again, you say, well, that sounds great, Professor, but what's the advice? The advice is that you should know your business and keep changing. Keep refining. I know, like, for instance, restaurants, right? I know a person who owns a restaurant down here that's been here forever, down on the shore. Great restaurant, old school. And they keep books in terms of every holiday, during the winter, during the summer, as to how much they sell. And then they go back, and every year they redo it, and they look at it again. They see if the economy changed. They look at it versus the economy, and they don't carry too much. Because let's face it, you carry too much inventory, it's basically food, and you got to throw it out. And they don't want to do that. But that's just a simple example. But a lot of people don't pay attention. They just have a standing order, and they don't think about it anymore. But those are things that can bring a significant amount to the bottom line, if you think about it. Financial leverage ratios, this is important because we want to see how much debt we're carrying. Again, industry specific. Some industries carry a lot more debt than others. The banking industry, notorious for holding debt, but it's an asset debt kind of thing. Big capital intensive businesses might carry on debt, like, say, for instance, Boeing. They may need capital to build all these planes, and then you get these big infusions of cash. But and then some businesses really don't have to carry a lot of debt. So total debt over total assets is the way we look at it. Total debt over total equity is probably the better way to look at it, because we want to see what percentage, even on a personal level, what percent, remember your basic accounting identity, assets minus liabilities equal equity. So we want to know that we're not carrying too much debt. I would say when you look at enough industries, 25, 30, 35% debt to equity or debt to assets is a good thing. So in other words, 65% assets, 35% debt, and that equals 100% of your company. I think that's probably, as a rule of thumb, a good number. You get too much debt, not only do you have to make those payments, and if they're adjustable, that could be a problem, like we're seeing in the commercial real estate industry, but it also gives us something called business disruption costs, where we're so focused on paying off that debt, we start missing opportunities. And anybody who's ever carried a lot of debt would know that it can be an ancillary problem. Not exactly about paying the debt, but about always thinking about maybe I shouldn't now extend myself. Opportunities come up you can't take advantage of because you've already overextended. These are things you want to think about. Too little debt? Well, let's face it, a lot of people make a fortune because they know how to use debt. In my mind, debt is like medicine. If you use it right, it's very good for you. If you use it wrong, you can really hurt yourself. So you got to know your industry, and you got to know how much debt you want to carry. And you also want to leave yourself enough room. You want to give yourself enough leverage where the debt's working for you and you can make good profits because think about it. If I don't carry any debt and I make $1 million in profit, well, that's my profit. But if I put some debt on, I can make, say, $1.3 million, $1.4 million, pay off my interest and I leverage my profits. So I gotta really think about that. And obviously, whatever you earn before you pay interest and taxes over your interest charge is an interest coverage ratio. Again, you want to comfortably pay your interest 5, 6, 7 times. In life, too, you want to be able to cover your interest by a fair amount after you take out your expenses from your earnings. Lastly, I'm not going to dig in too deep into dividend policy, but our profitability ratios are important. We take our sales, that's what it costs us to make it, over our sales, and that's what our profit margin is. Very industry specific. Some businesses have very high profit margins, but they don't have the inventory turnover. Some businesses have very tight profit margins, but they do a lot of inventory. That's really the relationship. So if I look at a supermarket like ShopRite, they have a very small profit margin because they're really giving people good deals to get them in the door, but they got to turn over inventory a lot. They need a lot of traffic in the stores to make that up. On the other hand, if I'm selling Rolls Royces, I'm not going to be selling them every day like that. But my profit margin has to be much bigger. So generally speaking, luxury goods, very expensive handbags, things like that, you want to have big profit margins. You don't expect to have that turnover. Well, then the move has to be, well, then if I'm going to cut my margins, I need the turnover. It's always that balance between turnover and profit margin. Okay, so you want to think about that. But that's what a good manager does, right? And sometimes within the same business, you can have one good that's a high margin good and one good that's a low margin good. Think about a pizzeria, for instance. Let me make it simple. Maybe these basic round pizza, the competitive pizza that has to be priced at the competitive price, you want to turn over a lot of those at $15 or $16 a pizza. But then if people buy the prepared foods and stuff like that, or the dinners, you can make a bigger spread on that. So profit margins are important, but they're very industry or product specific. And again, if you have a high margin, generally speaking, it links up. If you have a high margin and doing a lot of turnover, like the Apple iPhone, well, you see where that stock is. It's tremendous. But in most cases, it's linked to profitability. Return on assets is your income over your assets. So you have assets, they say you have factory, and your factory is worth $2 million. Your factory and all the goods and the trucks, and you're getting $200,000 or $250,000. Let's say $250. Let's say you got $2 million in a factory and trucks, and you got $250,000 in net income after your expenses. Pretty good. You're getting 10% of your assets. Here's the thing you got to be careful about. If I look at two companies, again, this all illustrates that it's got to be in context, like a news story. You can't just listen to the quote. You got to do context. If I have two companies company A is making a 20% return on its assets, and company B is making only a 10% return, I can't just blindly say company A is doing better. The question I got to ask is, what kind of assets are we talking about? Maybe company B just bought all new assets. Maybe they just built a brand new factory, which is going to sustain them for years and give them a more competitive product. And maybe company B is using really old stuff that breaks down and needs to be repaired at one point. That could be a problem. So just because I see a better asset turnover ratio, you have to take the time. And like anything else, you have to do the extra work, look into the business, and make sure that what you're looking at makes sense. And finally, if I have net income over shareholder equity, that's my return on equity. And that's what I'm worth, right? Assets minus liability is equity. And my net income is what I make. So I can see what I'm actually making on what the shareholders own. Again, industry specific. A couple of other things, dividends. This is just when I'm paying out in dividends. Not a big deal. I'm not going to cover that too much. But once again, a reference point is needed. Most ratios must be compared to historical values of the same firm. That's time series. I should always watch my ratios on a time series so I can see what they look like over many years and if they've changed, right? And most ratios by themselves are not highly meaningful. They have to be viewed as indicators, which I hope I got that point across in this. And that's basically it. So hopefully if you have any questions, let me know. Type it into the comments. And I hope you found this useful.